SoFi Technologies Inc. is trading live right now at $16.58 per share, climbing by 3.43% in an active intraday session that is completely upending the narrative surrounding digital banking. While most market participants are fixated on the standard macroeconomic metrics like interest rate spreads and loan origination volume, something far more structural is shifting under the surface. The market currently looks at this business as a hyper-growth consumer lender that is hypersensitive to Federal Reserve policy, but the unexpected reality is that institutional capital is quietly positioning for its transformation into a core financial infrastructure provider. Just recently, the company became the very first nationally chartered consumer bank in the United States to launch its own stablecoin directly integrated into a consumer banking application, an asset known as SoFi USD. This development breaks completely out of the traditional sandbox of public fintech definitions and moves them straight into a high-margin tech ecosystem that could alter how transactional settlement occurs between major institutions. The general expectation of the retail trading community is that this equity lives and dies by student loan refinancing cycles and the borrowing appetites of high-earning young professionals. If you read the mainstream financial media, the narrative is almost always about how stubborn inflation or delayed interest rate cuts will compress net interest margins and choke off personal loan originations. But the reality is completely destroying those expectations. Institutional accumulation has accelerated quietly over the last quarter, with mega funds like Norges Bank absorbing massive multi-million-dollar stakes despite a volatile broader financial sector. The reason for this institutional divergence is simple. While retail investors treat this asset like a standard bank, sophisticated capital is valuing it as a software platform that processes transactions for other financial companies. This tension between what the public expects, a cyclical consumer lender, and what the beta reveals, an enterprise financial technology engine, is creating an explosive divergence in valuation. When you track recent trading activity, the daily swings tell a story of immense capital rotation. On heavy trading volume, the equity has been forming a rigid base, routinely absorbing broader macroeconomic shocks better than its legacy peers. Just last week, when a hotter-than-expected jobs report sent treasury yields spiking and dragged down growth equities, this stock experienced sharp localized profit-taking, yet the underlying buying pressure remained incredibly orderly, indicating that long-term asset managers are stepping in to buy every significant macro-driven dip. This is not the behavior of a speculative retail stock, it is the fingerprint of institutional accumulation. Major funds are realizing that the company has now logged its 10th consecutive quarter of GAAP profitability, which automatically places it on the tracking radar for potential S&P 500 index inclusion. The moment a stock transitions from a speculative fintech play into a profitable index candidate, the structural buying from passive exchange-traded funds completely rewires the supply and demand dynamics of the equity. Think about the sheer scale of the operation as it stands today. We are looking at a platform that has crossed 14.7 million members, a scale achieved entirely without physical bank branches. This brings us to a crucial point about how consumer behavior is changing. Comment below how many shares of SoFi Technologies Inc. you currently hold, or if you prefer using traditional legacy bank accounts over digital-first setups. Gathering these distinct user perspectives helps map out exactly how quickly deposit migration is happening in the real economy. That deposit migration is the lifeblood of the corporate strategy. Legacy institutions have to support massive physical real estate footprints, maintaining thousands of physical buildings and localized teller staff. This digital competitor, by contrast, funnels those saved operational costs directly into superior annual percentage yields for its depositors. By offering highly competitive interest rates on checking and savings accounts, they are pulling billions of dollars out of traditional commercial banking networks and locking those assets into their own ecosystem, radically driving down their internal cost of capital. To understand why this matters for the stock price, you have to dissect how a bank actually generates profit. A traditional bank borrows capital from depositors at a low rate and lends it out to borrowers at a higher rate. When an online lender lacks a national bank charter, it must rely on expensive warehouse credit lines from larger institutions to fund its loans, which destroys its profit margins. By securing a formal national bank charter, this firm gained the ability to use its own sticky consumer deposits to fund its personal loans, student loans, and mortgages. This fundamental shift exploded their net interest margins, allowing them to remain consistently profitable even during periods when the Federal Reserve held interest rates at punishingly high levels. It is an industrial-scale financial flywheel. More deposits lead to cheaper loan funding, which leads to higher profitability, which allows for better tech features, attracting even more deposits. The software division represents the real hidden value that the market routinely fails to price accurately. Through the strategic acquisition of enterprise platforms like Galileo and Technisys, the company didn't just build an online banking app, it bought the digital pipelines that run modern financial technology. Galileo functions as the unseen operating system for the digital financial world, issuing API keys and processing transactions for major payment platforms, card issuers, and alternative online platforms across the globe. When a consumer uses a digital card on a competitive app, there is a substantial statistical probability that Galileo is handling the clearing and processing in the background.
background, earning a small fee on every single transaction. This means the parent company is essentially running a dual business model. They are an agile, direct-to-consumer bank on the front end and a B2B infrastructure provider on the back end, selling picks and shovels to the very companies trying to compete with them. Let us contrast this structural reality with alternative investment platforms and brokerage structures that dominate the modern market landscape. For years, individual brokerage accounts were siloed experiences. If an investor wanted automated algorithmic asset management, they had to opt for specialized digital platforms like Schwab Intelligent Portfolios. If they wanted aggressive options trading and fractional shares wrapped in a gaming-style interface, they logged into their Robinhood stock trading account. If they required deeply institutional tools and complex global market access, they set up an interactive broker's account. For decades, the financial services sector forced users to fragment their financial lives across multiple disparate logins, maintaining checking accounts at a legacy bank, holding retirement vehicles within Fidelity mutual funds or Fidelity IRAs, and executing short-term trades elsewhere. This digital bank is systematically destroying that fragmentation by consolidating the entire life cycle into a single app. Through its dedicated platform segment known as SoFi Invest, the company has built a framework that directly challenges legacy operators like Fidelity Investments. Within a single native mobile interface, a user can transition effortlessly from paying an automated utility bill to purchasing a fractional share of Tesla stock, buying Apple stock, or executing a trade on Nvidia stock. It matches the fee-free, zero-commission allure popularized by the Robinhood app, while simultaneously offering structured retirement products like traditional and Roth IRAs that appeal to older, wealthier demographics. By combining automated robo-advisory algorithms with active self-directed investing, the platform manages to appeal to both the passive long-term saver and the highly active day trader. It completely bypasses the need for independent online investing sites by serving as a comprehensive individual broker, cash management tool, and lending office all at the same time. This complete consolidation creates an incredibly high level of customer stickiness. In the legacy world, cross-selling different financial products is notoriously difficult and wildly expensive. If an older institution wants a checking account client to take out a mortgage, they usually have to spend thousands of dollars on targeted digital marketing, direct mail, and human sales agents. In this digital ecosystem, the cross-selling process is completely automated and frictionless. The data engine analyzes a member's incoming cash deposits, notices they are paying a high-interest auto loan or student loan to an outside lender, and automatically serves them an inline tailored refinancing offer with a lower interest rate. The customer clicks a single button within the app, the loan is processed through their automated underwriting system, and the entire transaction finishes in minutes. This keeps marketing costs near zero, while drastically expanding the average revenue generated per individual member. The latest introduction of an AI-powered financial guide named SoFi Coach adds another deep layer to this data optimization. This tool acts as an active, automated wealth management assistant that sifts through member spending habits, debt structures, and asset allocations to deliver highly personalized financial optimization strategies in real time. It replicates the core services of high-cost traditional advisory platforms, offering premium investment help to everyday depositors who would otherwise be priced out of institutional wealth management. This data collection allows the platform to understand its user base with an incredibly level of granularity, significantly reducing loan default risks because the underlying algorithms see the real-time cash inflows and outflows of the borrower before any money is ever extended. Looking ahead, the tension between market expectations and structural reality will likely be resolved through several clear future catalysts. The primary near-term milestone to watch closely is the continued expansion of the newly relaunched digital asset segment. After temporarily pausing its digital asset operations to comply with initial banking charter mandates, the bank utilized recent regulatory shifts to re-establish a natively integrated digital asset trading framework, becoming the first nationally chartered institution to offer direct digital asset trading and issue a bank-backed stablecoin completely changes their fee revenue outlook. As transaction volume scales on this public blockchain network, the company stands to capture meaningful settlement fees that do not rely on traditional credit markets or interest rate fluctuations, creating an entirely insulated non-interest revenue stream. The key risk factor to monitor is the overarching trajectory of consumer credit quality across the broader domestic economy. If macroeconomic pressures mount and cause a synchronized spike in personal loan default rates, the company will have to allocate more capital toward loan loss reserves, which could temporarily depress quarterly earnings reports. However, the bull case rests on the fact that their target consumer demographic maintains an average adjusted gross income well above the national median, providing a strong buffer against localized economic downturns. Additionally, as the corporate segment continues to sign up major global enterprise clients to its Galileo core banking software, the business model shifts further away from balance sheet lending risks and closer to a pure software-as-a-service recurring revenue structure. In summary, the central insight driving this equity is that the market is consistently mispricing a tech-driven platform by analyzing it through the outdated lens of traditional commercial banking. The mainstream expectation focuses entirely on near-term loan originations and net interest margin compression driven by standard central bank policies. The reality, however, is a rapidly scaling, gap-profitable financial technology network that holds a structural advantage through its national bank charter, boasts an incredibly low cost of capital via surging consumer deposits, and owns the digital pipeline infrastructure powering third-party financial apps. By unifying active stock trading, automated robo-advisory, institutional lending, and blockchain settlement into a single digital platform, the company is systematically absorbing market share from legacy financial operators. As passive indexing funds prepare for eventual inclusion benchmarks, the structural baseline for this asset continues to strengthen, offering a compelling case of a reality that vastly exceeds prevailing market expectations. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.